Picking stocks is important and picking the right stocks is important, but I think we all spend way too much time trying to figure that out. But to me, I think it's an important part, but a smaller part versus risk management. So for me, concentration is the key to making big returns, but you have to do it at the right time. Understand the relationship between your portfolio risk and the stock trade that you're about to take and the risk that that's going to take on. If you get into something that you shouldn't be in, fix it right away. The rule is just sell it. So in trading, it's just sell it. Always use stops for your trades based on the math. And if the math doesn't work from a technical perspective, don't just say it's going to be 8%, unless the 8% makes sense, because more than likely it'll get stopped out. The most precious thing you have is your capital, and you want to treat it like gold and, do whatever you can to keep it safe.
Okay, welcome back, everybody. It's my pleasure to introduce our next presenter, Deepak Uppal. Deepak is a top performer in the U.S. Investing Championship, where in 2023 he returned 259%, and he is currently among the top competitors in the Money Manager division this year in 2024. And he'll be presenting on likely the most important part of trading. This is something I'm really excited about, risk management, stop loss management. I know many of you have questions about this topic, and hopefully we'll get a chance to cover and answer all of those here today. Deepak, thank you so much for being a part of this, and really looking forward to this.
Thanks, Richard. I appreciate you having me join you for this conference. It's a great honor to be part of it, and I think you guys do a great job. So I'm excited to be here and share kind of what I think is, like you said, a very important topic, which is risk management for consistent returns. So let me go ahead and dive into this. All right. So in terms of the agenda that I want to cover is, I'll kind of go through my background, how I think about risk management, and then talk a little bit about each of those aspects of risk management, and then get into some examples of, some trades that I've taken and, how I kind of managed my risk. And then, some books and resources I found useful during my trading journey. And then we can open it up to Q&A to end it. Sound
Awesome.
good?
Let's dive in.
All right. So just in terms of my background, I've been trading for over 30 years and mostly just kind of on my own, just trying to figure things out. And over those 30 years, I probably have made like all the mistakes people think about and hear about when they read books and talk to other folks. But, I traded obviously stocks, I traded options, I traded Forex for a little bit, I traded Bitcoin, you name it, I tried it, and, was not successful for many, many years because I really didn't put any structure around my trading. And so, that trading was not my background. It was just something that I was found really fascinating and interesting. My background, for 30 years, what I did was I was in management consulting and in tech or software sales. And like you mentioned, I really took me a long time to kind of get to where I am, but I, studied and took some more structured kind of courses and read books and all this other stuff to kind of get to where I am. And I'll talk a little bit about some of the resources I used at the end that I found very, very helpful, that kind of helped me turn things around for me as a trader. And as of last year, I decided to put my skills to the test and go up against other great traders. And I finished in 5th place last year, as you mentioned, with a 259% return. And this year, I also decided to join the Investing Championship as well in the Money Manager division. And at the end of Q1, I was in 2nd place with a 45.7% return. I think the Q2 standings will probably come out in the next couple of weeks. So, excited to see kind of where I fit at the end of Q2. But, like I said, I really am very passionate about trading, and it took me over 30 years. But as of the start of last year, I decided to just do it full time because I had, the confidence in the skills and kind of what I had learned. And, that's what I do, and I love it, and I enjoy it thoroughly. Down below on the slide is a link to the interview, Richard, that you and I did in early January after the 2023 standings came out. And in that interview, if anyone's interested, I kind of go into a lot of the detail of, what I did and kind of the way I think about trading and how I pick stocks and other things. So if anyone's interested, feel free to take a couple hours and go through that video.
Yeah, just
But
jumping in. Yeah, I just want to double click on that. I think it's a really good, great resource. And today you're going to focus on risk management, but you really cover your whole process there and go through a lot more examples. So yeah, I would definitely recommend it for people after watching this. Take a look at that for sure.
yep. Yeah, so one of the things that people always ask me or friends, when you're talking to them and they know what I'm doing, it's like, hey, what stock should I buy? What should I buy? What's going to move up or what's doing well? And I can rattle off a handful of stocks and tickers that they should be thinking about that are looking good. But at the end of the day, if I gave those tickers to like 5 people or 10 people and I gave them a month, like they'd all end up with different returns. And only a handful of folks would probably make anything substantial out of those tickers. Because I think people are just kind of wanting the tickers and buy, but then they don't know what to do. Like, how do you manage your risk? How do you know when to sell, et cetera? And so to me, in my trading journey, one of the biggest things that was an aha moment for me was really learning about risk management. And I think that's the key to consistent returns. I mean, picking stocks is important and picking the right stocks is important, but I think we all spend way too much time trying to figure that out. But to me, I think it's an important part, but a smaller part versus risk management. And when I think about risk management and through my journey, kind of here's the 4 things that I found to be like the most important when you start thinking about risk management and getting consistent returns. One is market conditions. You really need to understand what market you're in as you're making your trades. And then the second thing is position sizing. That's real important. And I'm not sure too many people talk about position sizing, but I think, that's something that I'll go into. But it was a big learning experience for me. And it took me a while to kind of understand how to size my positions without getting nervous and things like that. But I think a lot of that comes through understanding how you manage your risk. And then, small losses is obvious, using stops. That's something that, you hear about, but everyone's a little different on that. And for me, that was kind of a big hurdle to get over for whatever reason. It took me a while to kind of, self do an introspection of myself and why I wasn't using stops. And that took me a little bit of time to kind of work through that. And then the last thing I think really is the most important is to understand your math, not the math, but your math. Like, how do you trade? What are your average returns? What are your average losses? What's your winning percentage? And then, understand that and understand whatever edge you're trying to use and work that into the math and understand that very, very well, so that you can be consistent about getting returns. One of the big things that I had problems with was that I'd have great returns when the market was great, but then I'd lose it all when the market went down. And that up and down really was frustrating and really took a lot of time to really figure out what I was doing wrong. On the right side, there is kind of my equity curve from last year during the competition from that account. And as you can see, most of my gains were in the middle of the year, like through the end of July. And I basically could have just been in cash the rest of the time and probably ended up pretty close to, where I was. And, I went through a lot of trading from July through December to end up actually a little lower than where I was at the end of July. So, I think it's important to understand, the market conditions and sizing and all that. And I'm going to get into that. But one of the things that I always hear about, or not hear about, is I follow Dan Fitzpatrick from Stock Market Mentor. And one of the things he always says is don't lose your dough. Otherwise you're going to be working at a 7-Eleven or something to make your money back. But it kind of just sticks with me all the time is that, the most precious thing you have is your capital, and you want to treat it like gold and, do whatever you can to keep it safe. So a big lesson that I learned was, really think about the capital that you have and not letting that go. So one of the things I did early on was I started to look at market conditions and trying to figure out, like, how do you know what the market conditions are? Here's an example of last year, right? Like when you look at the spiders from last year, they kind of had 3 or 4 phases, I would say. The first part of the year was pretty flat, a little choppy, I'd say. It went up, it came down, went back up. But really from May through like the middle of July was really the sweet spot where we were in a great uptrend. And then, from middle or end of July till like the end of November almost, the market was basically going down. And, then it kind of turned around at the end of November and went up. And when I looked at that and compared that to like my equity curve, and I did this earlier, previous years to it was kind of an aha moment for me. But if you look at my equity curve from the right, from last year, from the competition, right? I mean, it mirrors exactly kind of what the market was doing. And so the first part of the year, in the yellow, you can see there, um, you know, I was pretty choppy as well. I kind of followed, what kind of the market was doing. But then, in May through July, I also kind of I was part of that. I was able to make some good returns during that time. And if you look, I mean, it took me about a month or 2 months, and I was able to get a 200% return during that time. I mean, that's all it takes. You need just one good time of the year to jump on board and understand what you're doing, understand the market you're in, and try to get that return. I'm not saying it's easy, but it's something definitely that you need to bear in mind, that you can't be trading all the time. And then the last part here, was during the correction. And this, I actually kind of had a difficult time during this period, as part of the competition. Actually, my competition account actually went down because I was trying to be too aggressive and pressing to try to get the returns to, during the competition. It's interesting because when I look at my other account, that wasn't in the competition, it didn't go down as much, and it was fairly flat, because I wasn't in the market as much, trying to get the gain. So, and then at the end, you can see I, came back a little bit, in December when the market was doing well. So it was an interesting exercise for me to do, because it kind of helped me understand, how was I trading during those periods. And I'd say that's a great exercise for folks to do. Go pull up the equity curve, your equity curve from your account from last year, and compare it to the market cycle. And how does it compare? Were you able to, avoid the chop and the downturn here, or were you able to make a good solid return, during, the May to July timeframe? And if you weren't, dig into your trades. What were you trading? How much were you buying? What were your position sizes? Those are some things to kind of take a look at, so you can start to kind of dissect your tendencies in terms of how you trade, and kind of what kind of returns you're getting.
I just wanted to jump in with a question. Obviously that period where you did phenomenally and got 200%, or near 200% was a really fantastic period. And I like how you mentioned, it just takes one period like that to make your year. On in a typical year, how often do those opportunities arise where you get that kind of 2 month period where you can really step on the gas and make good gains? And maybe what are some things to kind of recognize in the moment that, hey, things are really, market conditions are good, and this is when I should be trying to accelerate and make that money when the market is good.
Right. I mean, and that's, I mean, that's the
The
big
big
task of
question.
trading, right? Trying to
Yeah.
understand what that is. So I'm going to talk a little bit about that, but I think it's a variety of different things. It's not like one thing you look at. You got to kind of judge it and feel it. But I think, like, when you look at a typical year, you probably get that a couple times a year, 2 to 3 times, I'd say at the most. It depends on the year too, right? If you're in a bear market, you're not going to get that, right? But if you're in a good market like we've been, we had a couple, it looks like two to three times last year where it was like this. This year we've had it, once or twice, I'd say,
Yep.
so far. It's been a little choppier this year than last year. We didn't really get that really nice, smooth, sailing, kind of like we did, from May through July last year. But yeah, I'd say 2 to 3 times a year you could probably get those sorts of periods of time, and they may not be 2 months, they may be a month, but that's really when you have to strike and go get your returns.
Yeah.
Um,
And one more thing, or actually, sorry, I'll let you finish your point if you had more to add.
no, that was it.
Yeah, I just want to say and kind of ask, and the rest of the year is your goal to just kind of, not hurt yourself, not overtrade, pretty much go flat during those periods when you're not trying to step on the gas.
Yeah, exactly. I mean, my goal is to try to stay even, flat, or, lose very minimal. You're going to get drawdowns during those periods because, you're just always feeling out the market and things, but, you want to try to avoid the big drawdowns during those periods.
Yep. Sorry to jump in. I just think
Yeah,
those are good
no, no.
points.
So, market conditions is a real important thing to understand. And it took me a long time to kind of figure this out as a key component of trading and managing your risk. So when I look at, how do you tell the market conditions, right? There's a few things that I look at, and I'll kind of walk through these. One is market cycles. If you go out there, there's lots of these available, or I mean, you got to subscribe to some of them, or if you're part of a service, they sometimes have these charts, but there's different cycles that are out there, right? There's a 10-year market cycle that says that, in general, here's how kind of markets behave on a 10-year cycle, right? And then there's a 4-year presidential cycle that has an impact on the market. And then there's seasonal cycles, right? Like from September through October is usually not the best time, but November through January is usually a pretty strong time in the market where you really get good returns. That's not to say that that happens every time, but if mentally you kind of just have these cycles in your mind, it's helpful. It helps me out. For example, in this one, right, this is from 2024, the S&P composite cycle. And you just want to see kind of what's the trend, right? I mean, here it is kind of a little choppy. It's up, but it's moving up, right? You get a little downturn, but then from June through, September, it looks like it's a pretty decent up cycle. Then we got a little some pullback through, November, and then it's up from that point on. So kind of similar to last year's cycle, but not that I'm going to trade off of this, but it's just mentally good to know like this is where we are in terms of this cycle, and just see how the market's doing, right? So that's one part of it. Just that gives you the big picture of where are we in the cycle for this year, right? And then you kind of look at the daily market. I look at the daily market environment as well. So there's a few things that I've got, and I shared this in the video that we did earlier in the year as well. But I've got just a little piece of paper that I go through and every day just write down the things that are going on in the market and the things that I look at. You may have other things, but these are the things that I like to look at. I like to look at what's the VIX at, what's the put call ratio at. I look at the percentage of stocks over the 200-day. I look at the bulls versus the bears to get an idea of sentiment. I also look at the CNN greed index, kind of gives you an idea also on sentiment. I pay attention to the IBD market trend. And then there's a few other proprietary indicators that I follow that are part of a couple of services that I use. So, I kind of have all that every day. I kind of look at it, see kind of what's this telling me from a daily market environment. It's a little bit more detailed, I think, than the market cycles. But at the end of the day, the best way to tell kind of what the market environment is your stock action. You're making trades, you're seeing how they do, and you're looking at looking at the performance of the stocks when they break out. Are they going up? Are they coming right back down to where they broke out or dropping down? And the most important is how's your portfolio doing? Like if you start seeing traction in your portfolio and you're starting to see some good gains, well, that's an indication that the market maybe in one of those market trends where it's starting to go up. But if the stocks you're buying, if you're buying good stocks that are set up properly and they're breaking out and they're running, that's probably the best indication that you're onto something, and that we may be at the start of a market rally. And one of the quotes that I think is real important that I try to think about all the time is you don't need to trade every day of every year. That's something Jesse Livermore said, and I think it rings true. If you're trying to be consistent and you're trying to get those big returns. So for me, general market conditions is a key component of managing your risk.
And you mentioned that stock action was kind of the most important of these three. How would you kind of weight the other two in terms of, what you consider when you're determining how you're going to be managing risk, how much risk you're going to have, how aggressive you're going to trade, all those different things.
Yeah, I mean, you may have stocks that are breaking out, but it's like kind of like where we are now, right? I mean, we're kind of way overextended, though the VIX is low, but the sentiment is really, really bullish right now, which tends to scare me. It's at close to extreme levels. And so, if you look at an IBD, bulls versus bears, right, you can see that we are pushing the top edge of the bulls. And so that's kind of something that kind of scares me. So even though I'm aggressive, I'm definitely not as aggressive as I probably was a month ago.
Hmm.
So I think that's kind of how I use that daily market environment piece of it. There's some indicators that are just saying, the percentage of stocks over 200 days is also very low right now, and so those two things kind of scare me overall, and the VIX is super low, so everyone's really giddy. But if things are working, keep going. And
Right.
that's kind of what it comes down to. So you got to balance it out. It's not one thing trumps everything else. It's kind of a balancing act, if you will.
Yeah, holistic. Yeah, nice.
Yeah, yeah. So that's it on general market conditions. And then when you go on to, position sizing is also something that I think is real important, especially when you combine it with market conditions. This is something that took me a long time to figure out what to do, because my general operating procedure was like, I'd always buy the same amount of a stock that I was buying. I wouldn't buy more. Just A, I was scared, and B, I just assumed like, hey, if I buy 1,000 shares, it's good. If it goes up a few points, that's great, or it'll double or whatever, right? And it wasn't until I read some books, especially like Mark Minervini's books, talking about concentration of a portfolio in a few stocks. I started to look at it and really dissect it a little bit and run some kind of scenarios around it. And I was of the mindset, what you always hear is diversify. It lowers your risk by buy like 10%, buy 10 positions in your portfolio, and you're good to go, right? And if you have a small stock account, right, having 10 positions isn't going to get you anywhere, because everything's always going up and down, right? So it kind of neutralizes everything. And that's kind of how you would probably get market returns, right? So for me, one of the big things was understanding how you size your portfolio or your positions in your portfolio. So for me, concentration is one of the key things that I've figured out is the key to making big returns. And but you have to do it at the right time. So 4 to 5 positions at the most, 20-25% position size. And I'll take even larger positions, 25% plus, if markets are in a strong uptrend. And that's the key. If you're in a strong uptrend and things are just going, I would be of the mindset of having 1 or 2 positions to really, you need to be in the right stocks, obviously, that are the stocks of the moment, if you will, and really press the gas to get those returns. And then having a lower concentration of a 5 to 10% concentration on a stock trade is kind of what I would do is in a difficult market environment. Or if we're in a bear market and you just want to kind of get a feel for stuff, testing the waters, buying some small number of shares to see how things are going, versus being aggressive when market conditions aren't warranting that. And then the last thing is cash. During a correction or a bear market, cash is something that a lot of folks don't think about. Like they always need to be in the market, something needs to be working. And so that was kind of a learning for me as well, because I did all these things, right? I was markets going down, I'm buying my normal 1,000 shares and getting clobbered, not going into cash, because there's always percentages to be made, right, no matter what. And so those are some things that I had to rewire the way I think. And those were really helpful for me in terms of trying to understand how you manage risk in your portfolio. So let's talk a little bit about, I talk about, being concentrated and having, especially when the market's good, right? Or even when the market's bad. One of the key things you need to learn to do that took me a long time was to use stop losses. There's lots of different things around stop losses, and I'm going to just boil it down. This by no means kind of a full list of types of stop losses, but you know, when you read a lot of books, they say, hey, just use an 8% generic stop loss. Once you make a trade, go 8% and you're good to go. There's that. There's a technical stop loss. So if you're looking at it from a technical perspective, there's certain areas that make sense to put a stop loss on. So you need to, look at those potentially as an area for a stop loss, or you can use even a trailing stop as a stop loss, right? Especially if a stock's moving quickly or really kind of accelerating to the upside. But a lot of people don't use stop losses. And there's a variety of reasons. These are just a few that that I put down that I think that I was probably guilty of, right? It's an admission that I was wrong on a trade. I always believe that if a stock goes down, it'll come back. Or it was just being lazy, right? Not doing it, not going through the work of figuring out that trade fully. Not understanding the math of investing, which was kind of an important thing that I don't think a lot of folks take the time to do. I didn't do it for 20 plus years probably, but once I kind of got into it and started to understand what that meant, it was really it changed my game. Or people don't know where to put the stops based on technicals of a chart, or else some people think stops don't work because they always get hit and the stock turns around and then runs, and they weren't in the stock. Those are called shakeouts. So it happens, and you guys just deal with it and live with it. It's part of the business that trading is all about. So Mark Minervini, uses this great quote: "Not using stops is like driving without brakes." Right? That you'd be insane to drive without brakes in your car. It's a similar sort of thing with your money, right? Why take a stock trade and all the money is at risk that you have on that trade, right? Versus if you have a stop, you can manage that risk in terms of how much, where that stop is and how much risk you're taking. So stop losses are so important. And this is something that I think a lot of people struggle with. And it's just something that you need to kind of think through, why you would take a risk on all your capital that's in that trade versus managing that risk and just taking a smaller loss. You can always go back right into the stock if it starts to turn around and jump right back in.
Yeah, I love the bullets there, and especially the last one. And to your point on shakeouts, you can always buy it back on the next setup if it tightens up again. And sometimes the shakeout almost improves the setup in a way because you shook out all the weak holders, and then the stock can be ready to rip. So yeah, I love those points right there.
Yep. So stop losses, I think, is a real important thing to understand, and to figure out, if you're not using them, why you're not using them, and if you are using them, figuring out if you're getting stopped out a lot. There could be a lot of different reasons of why. Maybe you're not buying it right. Maybe your stops are too tight. I mean, there's a whole variety of reasons, but that's where I think it'd be a good exercise to take some of those trades that you've made and put them onto a chart, and where'd you buy it, where was your stop, and then take a look at it and see if it makes sense. The other thing that I think that for me was also a real important thing was understanding the math. And for me, there's really two types of risk that you're trying to manage, right? One is your portfolio risk, or the capital that you have. And typically on a trade, you want to probably not risk more than 1 or maybe 2%, 2.5% of your portfolio on a particular trade. So, and then the second thing is, well, let me talk about the portfolio risk piece of it first. So I've got this portfolio tracker it's just an Excel sheet, right, that I put in. And really, I just update the portfolio value when it goes up. I'll put in the current value. My max loss is usually, for me, I use a little bit higher, but max loss is 1%, maybe 1.5%. And then I've got the risk, the 1R, which is the risk you're taking. The 2R is, if you double for every dollar you invest, you make double. 2R is kind of the ideal, typical what you're trying to do, but You know, obviously you're trying to get higher than 2R return on your trade. And you know, mine goes across the board, you know, from 3, 4, 5, 6, 7, 8 on the spreadsheet, but I cut it off here at 3. But you know, so that kind of gives you an idea of, like, when you look at your portfolio, you see it's up like $4,000 on that trade. You know, you're at 4R of your risk typically, so you may want to sell or cut it in half. So at least now you've gone to a 2R in the bank, if you will.
Right.
And you know, so this is something simple to do. So if I was going to buy NVIDIA, for example, you know, I'd put in the price that it was at. It's at 122. I've got mine set at 25% of my portfolio. That means I can buy 204 shares. And to be at a 1% portfolio risk, I can have a $4.90 risk on that trade. So once I know what my max risk is, then I got to look to say, okay, if I buy it at this price, does a technical stop make sense on this? Or should I just use the 490 and go into it? And what are the chances of me getting stopped out because it's just like not really a good technical spot to put the risk? And I'll walk through some examples of this too. And then on the other side, you know, like I said, I always heard, like, you know, take an 8% risk on your trade, right? And in this example, if I were to take an 8% risk, a max risk on this same trade, right, I'd have to take a $9.79 stop loss, which would mean I'd be risking, you know, close to $2,000 or 2% of my portfolio. And it sounds simple. It's kind of like, no kidding, like that makes, you know, total sense. But I never used to think about things in that perspective. I used to just say, okay, I'm going to put an 8% risk, right? 8% loss. But if I was only, you know, investing 12% of my portfolio, yeah, that would make sense, because then my risk would be 1%. But if I was investing 50%, right, and I just used an 8% loss, I'd be risking quite a bit of my portfolio and my capital, which doesn't make sense. So using the max 8% loss just generically, I think is a bad idea, even though that's kind of what you read in a lot of the books that you read, especially, you know, like I remember that was always an IBD max risk is 8%. And once you kind of start to think about it and understand it in the perspective of managing your portfolio risk, I think it makes a little bit more sense. But you got to balance the two accordingly, so that you're not just using an 8% max risk, if that makes sense.
Yeah, not by default using 8%.
Yeah, exactly. If it makes sense from a technical perspective, and that's 8% and it's 1% of your portfolio, then that's great. Use it. So I'm going to walk through just some examples of kind of how I use this in my trading. And so the first example I'm going to use here is Palo Alto. So these are all really current trades, right? So when you looked at this thing was setting up really nicely. And so I took the trade, I bought it as it was coming out of this small like pivot or consolidation here. And I bought it as it was coming out at $322.62. And so I put it into this trade tracker, and I bought 25% of my portfolio. And it meant I could get 77 shares at $100,000 on a $100,000 portfolio. And my point risk was $12.90. So I could have gone down up to $12.90 on this trade for it to be within my 1%. But what I saw was that, you know, that would put it right down here at this point of this bar, which is kind of a risky place to put it, because chances are it could come down to here and there'd be nothing wrong with that trade, right? It could then shake you out and just go right back up. So I didn't want to use that as my stop. And so what I did was I actually took a little bit of a larger stop. I took a $15.19 stop to put it underneath the 21-day line here. And as the 21-day line was going up, I figured that might be enough room for this to, if it was going to go underneath the 21, then I probably want to get stopped out versus taking that risk that it comes down to the 50-day here. And so I took a little bit of a bigger risk, but my thought process was, you know, I took a 1.16% of my capital was at risk on this trade, even though I took a larger point risk or dollar risk on the stop. But the risk on my stock trade was only 4.7%, which is, I think, a pretty good risk. I try to keep it 3 to 4 to 5% in terms of my risk on a stock trade, right? However, if you look at it if I just use the generic 8% and I just said, hey, I'm going to buy it here, I'm going to put an 8% stop, right? I would have had almost 2% of my portfolio at risk. So close to $2,000 with a $25.80 stop. So I hope that makes kind of some sense in terms of how I think about a trade when I'm going into it. Like those are the things that I'm looking at and thinking about, just to manage my risk. And that's a 25% position size. And like I said, that would be like more with a good market like we've been having over the last month or two.
Are you often trying to put it just below the 21 EMA or what? Yeah, the 21 moving average there.
No, not necessarily, but like in this one, it was just so close to it. Like I would go underneath it. I mean, it just depends technically where the stock is. It's not a hard and fast rule that I would do that all the time.
Gotcha.
Because sometimes if it's really extended, if I were to buy it here, for example, right, that would be way too low
Right.
to put that stop. So yeah, it just happened that in this trade, this was so close to the 21 day. I just took the extra, I think it was like $1 or something extra and put it underneath it just so there'd be a little bit more room. And also I saw that this was kind of moving up
Right.
in an upward trajectory, that it would be kind of pretty below the 21 day, that should keep me hopefully from getting shaken out. And then, the stock turns around and moves.
And I think a question that people watching are probably asking is, as the trade progresses and here pushed up after your buy point, are you, as you mentioned, are you continuing to use that 21 day moving average as your stops? You're kind of trailing it beneath that, or are you doing some other method to move up your stop as the trade works for you?
Yeah, so great question. I've got actually a slide I was going to show at the end, but what I would typically do is like once this thing starts to move and I've got a little bit of a cushion, I'll start to move up my stop, right? And like I would probably move it up to like being right below these. Like if it
Two
was like,
bars.
yeah, a couple bars here, like below that would be probably my next stop. And as the stock moves up, like I would keep moving it up. So stock stops are something that you should definitely be looking at like every day, right? Based on what the stock did the day before. And so you got to adjust your stop so that you're at least not going to lose money, especially if you're in the green, right? And at this point here, a logical stop would be either right below this bar right here,
Hmm.
or maybe it's kind of an interesting one because it could potentially fill this gap where it gapped up, and you could put it like right below there as well, like right below that close,
Hmm.
a buck, maybe $1 below it. But then you're risking a lot of your gains, right? So I probably wouldn't do that. I would probably just put it like right below this.
Yeah, and to ask a follow up, would it be after we had that gap up that you would adjust your stop to below those two lows that are pretty close together, or at what point would you want to move it up to that point that you pointed out?
Yeah, I think I would probably like, there wasn't really that much of a profit to begin with, even when it was up here. I mean, it was
Hmm.
like $5. So it was okay, but it wasn't even probably close to 2R. So I would have probably I did wait on this one until it moved
Gapped
up
up.
till past that.
Gotcha.
Yeah.
No, that's perfect. Thanks.
Yeah. Here's another example of a trade that I took. So this was Eli Lilly. And as you can see, like, this was pretty good resistance here across over the last like probably 2 months, 3 months. And so when this thing broke out, I bought it on the first day at 801.23. And at 801.23, right, I actually loaded up on it just because I thought this thing was going to move. And I took a 75% position on this trade of my portfolio. So as I went through it, I took 94 shares and I could have a $10.68 stop to be within my 1% max loss on the portfolio. And so when you look at this, right, that was the max stop. which I did take. So my stop loss was at $789.73, right? Like it was right below the low of that open of that day. And so that's where I took the trade, and that's where I had my stop loss, $10.50, and I was risking about 1% of my capital. The risk on the stock trade, the actual trade risk on this trade was 1.3%. So if I got stopped out, I'd lose 1.3%. And so what ended up happening on this trade was, it was behaving pretty well. And then, like we talked about, it came down and it shook out the low on this, and I got shaken out. Um, so I got shaken out of this thing, and it turned around and then just ripped. And it really, I guess I could have rebought it around here, but I didn't. And then, it just kind of took off, and it was one of those trades where you say, oh, shoot, I missed that. But that's what trading's about. I didn't, sit around and, cry about it, but it kind of hurt a little bit, but it is what it is. I was safe with my money, and I did kind of what I would do all the time. So it was fine. Now, if you look at it, if I would have just taken the 8% generic stop, it probably would have worked out in this situation because I wouldn't have gotten stopped out. But my risk, if it had gone down, because it's a pretty volatile stock, I would have been risking almost $6,000 or 6% of my portfolio on this one trade, which is, just way too excessive. So, but that's the kind of stuff that happens. And this is just an example, like it happens to all of us, right? Like this kind of stuff. So you can't, you can't say the stops don't work. They're there for a reason.
Yeah, I don't remember who said it, but somebody said we manage risk in real time. So, as the stock is pulling back in there, it could easily have turned into a failed breakout. You don't know. So we gotta manage our risk when we have it and get out when we can for sure.
Yeah, exactly. So, yeah, so I wanted to share that example. And it was a very oversized, when you look at it, it was a very oversized trade at 75%. So, when you look at it and, everyone's like, wow, that's so, risky of you to take a huge one big position like that in your portfolio. But when you look at it, if you manage it properly, like you're not taking that big a risk, right? I was taking a 1% risk on my portfolio on that trade, which is like any other trade that I would do. But I thought that the upside would have been much larger. And in this case, it was larger, but I got shaken out. So that's the way it goes. But taking a large position or concentrating your portfolio into one or two stocks doesn't mean that you're just being very risky and just kind of like gambling, if you will, in your portfolio. The next trade was NVIDIA. So one of the things that one of the things that I've learned to do, and I typically do it all the time, is like I won't hold or over earnings, no matter what. Like even if I have a cushion, usually I'll sell out, and if I have, and the reason I do that is that if I keep a small position over earnings, to me it's kind of like, okay, I'll keep it, but I'm not really going to make that much on it. But my downside is always there, right? So why do that? I'd rather just sell it, take my profits, and then let the earnings come out, because if the earnings are good, we'll see how the stock reacts. But if they're bad, or they're okay, but the stock goes down anyways because expectations were too high, chances are you might have a better trade that it could just come back up the next day right after it falls. It might give you a good buying opportunity. But here's an example of NVIDIA of what after their last earnings, right? I sold out the day of the earnings, before the earnings were going to be announced on this day, and I had bought this earlier, so I had a nice profit going on this trade. I sold it, and then the next day when it opened, obviously they had these stellar results. The stock gapped up quite a bit. I forgot what the percentage was, but it was I think it was like 10% or something like that. It was up at the open. And so what I did was, and everyone was upping their targets. And so the situation was right that I just took the stock right kind of when it opened within the first 5 minutes. And I took a 50% position on it, right? So it was a pretty aggressive trade for a stock that was already up 10% at the open. So what I did was I took the trade, I bought it at 102.44 and on this day, but what I did was I put my stop right below the low of the day. So wherever it opened, that was the low. I put a stop right below it. And if the stock was going to go break that, then I knew that it was not a good trade, right? Or it was going to try to go back and fill that gap. And so I put my stop at around $100.73. So when I, put it through the tracker, 102.44, I got 488 shares, and my risk was $2.05 was the max loss that I could take. But when I looked at it from a technical side, right, my technical stop was a lot less. It was $1.71. So my risk was really small on this trade. So I just put it right underneath there and just held it. It never broke that low of the open, and it just kind of started to run after that. So you look at it, I was risking 0.83% of my capital on my portfolio. The risk on the stock trade was only 1.6%. So if I would have gotten stopped out, it was really minimal. But for me, I thought that the upside was huge on this stock, just based on kind of how the market was treating NVDA, AI, and all that, right? So that was the theme. And so I was pretty comfortable making that sort of a trade. However, if I would use an 8% generic stop on that trade, it would have been about 4% of the portfolio, which is a little too large, I think, especially at a 50% position size. And so, this trade worked. And in this situation, it gapped up again. And I had to stop right underneath this gap the next day. And I did get stopped out. But, I made quite a few points on it. I think like 10%, 15% on that trade. So it was a good trade. And, now I just waited to reset, and it reset over here a little bit. So I bought some more. But a similar sort of thought process of my buy at this point as well.
And it sounds like mentally, each time you traded it, it was a new trade for you because you mentioned even before the earnings gap, you owned it and you sold it beforehand, and you're treating every new trade, you're going through the same process. What is my risk to on the stock? What's my risk to my portfolio? And just recalculating that every time.
Correct. Yep. Every trade I take, like even if I buy in like, increments, then each trade is separate.
Right.
All right. So that's the NVIDIA example. Here's an example from Meta. So this is a stock that, has been consolidating for a while. And to me, it looked good. Like there was a little pivot forming here, a little consolidation. So I wanted to buy coming out of here on this date. And so I did buy it when it broke out of this consolidation. And I bought it at $505, 25% of my portfolio. So I could buy 50 shares. And the risk I could take was $20.20 on that trade to fall within the 1% max. And so when I looked at it, right, once again, the $20 would have been probably somewhere around $20 from 505 would have been about 185 or 485, which would have been around here, which would have been fine. I think that would have been a good stop loss. But then when you look to the left, you see this long bar, right? And I mean, this was a pretty bullish bar. And so I thought, well, this would be kind of like if it falls below this, is kind of means that, it's going to close that gap, or it just isn't as strong as you think, or it could come back and close this area. So I put my stop actually right below, I think $1 below this low of this bar. So it was an extra $2 that I had to put onto my stop. So I was risking actually 1.1% of my capital, which was a 4.4% risk on the trade. And that's kind of, what I ended up doing. So, I'm still in this trade, and I think this is like,
It's pushed higher nicely.
yeah, it's much higher now. But, and once again, if I would have used the 8% generic stop and not done all this calculation and the work, right, it would have been 2% of my portfolio with a, $40 stop loss. So just another example of really trying to understand the math and where your technical stops should be, and what kind of position sizing you can take without risking without risking too much of your capital. The next trade is MicroStrategy. So this was a trade that I took. Kind of Bitcoin was bottoming after its run. I think this was like the start of May, end of April, start of May. And so, there was definitely a downtrend. It broke the downtrend and then it started to consolidate here. I like this kind of inside day. Next day was also a good, strong close. But then it popped up the next day, it gapped up. And I think Bitcoin was just starting to move up. And there was a lot of talk around the halving or there's something around Bitcoin that was going on. So it made a nice gap in the morning. So when it made that gap, I kind of did the same thing I did with NVDA. I bought it right away in the morning in the first 5-10 minutes. And I put a stop at the low of that first 5 or 10 minutes bar that was there. So, I bought it at 13.79.33. 25% of my portfolio, which means I could buy 18 shares. And I had a $55.17 stop loss that I could take on it. But my stop was so close and so low to this thing. I put it right underneath the bottom of this, which was only a $30 stop. So, I risked 0.5% of my capital. The risk on the stock trade was 2.2%. And, the stock did well and I started to, get out of it as it moved up. I think from here to here was almost a 400 point move. So, this thing moves a lot, but it's kind of a wild bucking bronco, as Mark Minervini would say. So kind of a dangerous stock to trade, but you can trade it if you keep your risk manageable.
And is that oh sorry, just want to jump in with a question. And is that why you only risk 0.5% of your capital there, which for you on a relative basis is kind of on the lower end, kind of for total account risk per trade?
Yeah,
Yeah.
the reason I did that was because technically, right? Like my thing was, if this is really that strong of a gap and it's going to hold it, then it should just hold it and move up, right? It shouldn't come back down. And so that's why I could use a stop at the low of the open or whatever, whatever that was at. It was a little bit higher than, I think it was like 13.52 or something like that. And so since this is a larger dollar stock, I keep this, I'll give it $3, $4, $5 from the low as my stop versus just $1 because it can move $1 pretty easily. All right. So the other example I was going to just talk about, you had mentioned hey, I wasn't in this trade, but if I was, this is one that's moved recently, just had a stellar gain of almost, 60, 70 points in 5-6 days. But in this sort of situation, if you were in this stock, this was probably the point to buy it as it maybe moved out of this little consolidation here on this day or this day or this day, you could have probably bought it. But if you were in the stock, how would you manage this in terms of stop losses, right? You'd have your initial stop loss wherever that was, but as this thing started to really accelerate, right, you would probably start to move your stop losses. I would have done it, would have been underneath this low. And then just every day as the bars are not coming down below the previous day, I would just keep moving the stop to that lower, whatever the low was of the previous day's bar as my stop loss. So just keep adjusting it every day. So you're kind of ratcheting yourself up. You can also be selling some of it on its way up more towards the high and then put your stop loss in, from the previous day's low so that you're starting to really capture that gain as well and not just letting it ride. So lots of different ways to do stop losses, but that's kind of how I would approach a stop loss on Tesla if I was in this trade. But I thought this was kind of an interesting one to kind of show how you can a way to manage your stops on a stock that's kind of going a little parabolic here.
Yep.
So yeah, those were kind of the examples that I had, and then what I wanted to do is just share kind of the key takeaways. That's kind of the key points I wanted to make. One was around, market conditions, is really understanding, where we are in the market cycle. And there's, different ways, a macro, kind of a more of a day to day. And then the biggest one is, how stocks are behaving and how your portfolio is acting, right? Um, Trying to understand and balance between those three in terms of market condition. Position sizing, we just went through that, getting aggressive when the market's in a strong uptrend and really treading carefully during a choppy market conditions. I kind of feel like we're in a very choppy market right now to a certain extent, right? But the other thing is, small losses using stops. Always use stops for your trades based on the math. And if the math doesn't work from a technical perspective, don't just say it's going to be 8%, unless the 8% makes sense, because more than likely it'll get stopped out. If it doesn't make sense, don't take the trade. And then, understanding the math, which is, the examples I just went through, understand the relationship between your portfolio risk and the stock trade that you're about to take and the risk that that's going to take on. So kind of balancing between those two, I think is real important. Any questions on that?
Yeah, and I think this sums it up really nicely. And thank you for putting this together. I definitely have some questions. First, would you mind going back to the position sizing slide that you had? Sorry, that's kind of at the earlier end.
Yeah, this one.
Yep, right here. So yeah, I love this slide. I think it's excellent. First, from a kind of here you've kind of got it segmented. A strong uptrend, good market, 25%, 25% plus. Testing the waters, 5 to 10%, and looking for cash in a correction. Um, from an overall portfolio exposure point of view, so not talking position size, but total position portfolio exposure, what are you trying to do in a strong uptrend versus a testing the water situation?
Yeah, good question. So in a strong uptrend, I mean, I use margin, and I think we talked about it
Yep.
in the other interview that I had with you, is that if it's a strong uptrend, I am fully margined out. I'm going, maybe two positions at 100% each in my portfolio, but I'm using the same risk management tactics for stops and the risk I'm taking on my portfolio. Um, that I just shared. So, I feel more comfortable just because I've been doing this so long. But I would say if you're a newer trader, yes, stick with the 1 or 2%, don't use margin. But if you are, if you've been doing it and you're kind of comfortable with it, that's kind of what I use to make those big gains during strong market up cycles. Um, and I may loosen up my risk as well, right? I might take 2% risk or 2.5% risk on each of those two trades, right? So 5% of total portfolio risk, I'm okay with that. I'm comfortable with that. A lot of folks aren't. So it just kind of depends on your own risk tolerance, if you will. And then if lower concentration, if we're in a difficult market environment, I mean, I might put 10, 20% of my portfolio into the market,
Hmm.
but probably not more than that. And I won't be concentrated in a lot of different, in 1 or 2 stocks. I might be 20%, but I might be in 5 stocks at that time or 4 stocks, just kind of seeing, and maybe all from different areas as well, just to see kind of what's going on in the market. Are things behaving well or not? And just to kind of keep a pulse of the market. A lot of times what I do is if I'm going to be 10% or 20%, I may not even buy a stock. I might just buy one of the indexes and just kind of hold on to that and kind of see what it's doing.
Yeah, I really like what you just said there about feeling it out um, and having those different feelers maybe in different potential leadership areas and themes. I think that that's a golden nugget that people should pay attention to.
Yeah, like I mean, I trade a lot of the ETFs, so I'll trade the stocks for to see kind of what's going on. I'll trade the Qs. I'll trade the biotech ETF,
Yep.
and like I said, in biotech, I find trading a particular biotech name very difficult, but I would trade the biotech ETF and buy a little bit and see kind of how it does, right? To see if things are going to start moving in that sector or not.
Yeah, and getting back to your concentration, when you're talking about that, and just now, it reminds me of the Stanley Druckenmiller quote. Put all your eggs in one basket and watch it very carefully. That's kind of the methodology that you follow as well.
Yeah, and you know what, for me, I just find it easier like to have a handful of stocks. I mean, honestly, I probably trade, if I were to go through all my, all this different stocks I trade, I probably trade like 10 to 15 stocks during the course of a year, and that's it. I'll keep going back to the ones like, I probably traded NVDA like 10 times this year already. I'll buy it and I'll be concentrated. I'll let it go up. I'll make, the 3, 4, 5 hour on that stock. You can make 5, 6 hour probably on a trade if you get it in at the right time from the right spot. I'll make that, I'll sell it, and then I'll just wait for it to set up again and go buy it again because I find it that, I like to learn kind of how stocks behave. Different stocks behave differently during different parts of the day, and they do shakeouts during the middle of the day and come right back to close strong. But like if you kind of know how stocks trade, it can just kind of help ease any fear that you might have in terms of, hey, it's the middle of the day, it was up $5, now it's only up $1.50, right? Only to come back and close up $6 at the end of the day. So a lot of stocks, they have their own personality and their own way to move. So I find it easier to just trade a handful of stocks and just keep going back to them as they reset.
Yeah, excellent. And another question regarding exposure and this slide here, I'm sure, people always are asking about progressive exposure and how you go from kind of the test positions to then, all right, the trend's strengthening. I'm noticing that things are working. How do you kind of scale from 5 to 10% positions up to that 20, 25% when you recognize that shift and you recognize it's a time to start getting aggressive?
Yeah, I mean, I'm a pretty aggressive trader. So for me, it's, I'll change it on a dime if I start seeing things are moving. It's looking at the charts as well, right? If the market starts moving up and the testing that you've done, and those stocks are starting to move, right? That's kind of an indication that, hey, things are turning around, especially if your feelers that you have out there start to work. Then take a 25% position size on a stock and see how it does. And if it starts to move, add to it, or find other stocks that are starting to move and are set up properly. And, I'll go from 10% to 150% and, you know, in a morning if things are starting to move.
So just to dive a little bit deeper into that, say you put on 5% positions. If does it take four of them to work for you to get more aggressive, or is it three of them to work, or is it really just more of a feel for how those stocks are doing as well as the setups that are appearing in the market, all of that. I understand there's a lot of nuance there, but just to add a little bit more
Yeah,
detail
you know
there.
what? For me, it's more of a feel. Like I
Hmm.
remember last year, I think in May, kind of when people were still pretty negative because I think we were just coming out of the whole banking crisis last year.
Hmm.
And I think that was last year, yeah. And so, in the middle, at the start of May, I think things were kind of like everyone was still pretty negative, but I think I bought Netflix or something and I bought it and it started to just run. And then all the mega caps just started to go. And so it was just kind of a part of it. Part of it was a feel, and I just started seeing things moving, and I just went in pretty aggressively at that point. And so I caught it early, and I, stayed in it till middle of July when things started to sell off. Right, things started to turn around. One of the things that's kind of a good telltale sign is if you see the market just shoot up in the morning, everyone's aggressive, everyone's buying for the first hour, and then things just turn sour, right? I mean, that's kind of the start of a turnaround many times. So I look for that. If I start seeing that happen, then, and it's not just one stock, but like everything starts to turn. That's kind of an indication that we may be towards the end of that little cycle, if you will, of uptrend.
Yeah, and I actually wanted to ask about that as well. When we go from a strong uptrend and we've been in that for a few weeks, maybe a month or two, what are some signs that you look for to say, hey, okay, now I'm not going to be as aggressive. I might not go 20, 25% on a typical trade. I'm going to size down back a little bit, be a little less cautious, try to trade less, I guess. What are some of the signs that you look for in terms of price action?
The biggest sign I look for is I look at my portfolio. And if my portfolio is up, 7, 8%, and that day, like that's kind of a sign. Or if it's up that much in the morning, like if you get that sort of a big bump up in the morning, that's not going to last, right? And that's where you should start to trim down your size pretty aggressively. Like, so what I try to do is that once I see something like that, I'll just sell half of everything I have
Hmm.
and then just kind of watch, right? So I'm still in it. If things turn around, at least I have half my position still in there. If not, I've kind of saved half, and then I'll keep watching. And if things start to deteriorate even more, I'll start to sell. But I mean, when you start seeing crazy moves, it's kind of an indication that, we may be ready for a little correction.
Yeah, perfect. And maybe we could go back to the Tesla example for this question. Um, but maybe any of them would work. But I want to ask more about when when you're not just moving up your stops, but considering selling some into strength. For you, you're a swing trader. You're pretty aggressive in your sells and also moving your stops up. A position trader might be playing this Tesla trade a little bit differently. Trailing at a moving average. Trailing a percentage off highs. But for you, when do you start to consider selling into strength? Is it when you reach an R multiple and you kind of want to lock stuff in? How do you kind of approach that?
Yeah, so I really do try to use the R multiple because I think this just kind of keeps it a little bit less
Subjective.
emotional.
Yeah.
Yeah, it's just kind of like, hey, if I get 3 or 4 R on a trade, if I got 5 R, I'm gonna sell half of it, like
Hmm.
no matter what, just because that's a pretty good trade, right? And then maybe keep the other half and then put some trailing stops, and then I'll look at it like, what technically would be kind of an indication that this is turning around now, right? Especially like when you look at, like, for example, on MicroStrategy, right? This was kind of a good example of what I meant. Like, here's a day where it closed strong. It
Hmm.
opened the next day. I don't have the open where it opened, but it did go
Hmm.
above that bar, but then it didn't really make any progress and it started to turn around and then started to come right back down, right? That's an indication right there that, maybe this little upswing of 400 points is kind of over for now. And that's where you got to like learn to just get out.
Hmm.
So even if you wouldn't have gotten out here, this next day would have been another day where it broke this low. You should have been out of it by then, because then it did correct for a few days and came down, and it's been correcting since then.
Yeah.
So yeah, I
Yeah.
mean, a lot of it is based a little bit on feel, but also technically, like, what is the chart showing you? What's the chart doing? And adjusting your stops accordingly.
Yeah, excellent. And one other question I had, and maybe we go to LLY for this one, because it did have that shakeout there intraday. Um, it seems like your stops are anytime, anywhere, while versus other traders might look to um, sell only on the close if it triggers on a daily close, or some even longer term traders are more like a weekly close. But it seems for you it's like when it hits that level, you're out no matter what time of day it is.
Yeah, I don't really look at the time of day. If it's not doing well, I'm gonna get out of it and save my money. But my trading is very, like, that was a good point you made, right? Like, for me, everything I'm talking about here is very like swing trading.
Yeah.
My average hold time is, probably 4 or 5 days, 6 days max, um, for a trade. So I don't really hold on to it very long, but I'll put on bigger positions. But if I make 3 or 4% on a trade, 3 or 4% on an $800 trade is a pretty good return from a dollar perspective, especially if you're um, overweighted on that stock, or even if you have 25%, that's still a pretty good return.
Yeah, and do you have any specific rules about if you do get stopped out, it reverses strong and then sets up again, you look to buy it back, or it's just kind of, if you see it again when you're going through your focus list and you notice the setup again, then you'll take it, but you don't have any kind of hard or fast rules about getting back in after a shakeout like this.
Oh, I mean, if it's a shakeout, and I would try to get right back into it.
Hmm.
Lily was kind of an interesting one. I think I've mentioned in the past that I really don't like trading biotech stocks, or healthcare stocks in general. And I just not have never had luck with Lilly, but this looked good to me, so I traded it, and I got shaken out on a great, what would have been a
Yep.
great trade. So it's just kind of, you have these mental, I think, things around, trading certain types of stocks or certain names. But that's why I didn't look to get back into this one. But there's certain focus stocks. Like I said, I probably have like 10 focus stocks that I'm always looking at. And those are the ones where if it was to shake out and I got shook out, I'd be watching that real carefully to see if it sets up again and it makes sense to buy it with a limited amount of risk.
Yeah, perfect. And for this one, if you hadn't gotten stopped out here on that shakeout, how do you think you would have handled selling this and moving up your stops for this example?
Yeah, I mean, this thing was pretty strong for a good 2, 3 weeks, I think. I mean, I would have probably gotten shaken out, or not shaken out, but I would have probably put a stop like right here underneath this one
Hmm.
this day, and I don't. It looks like it
Undercut
dropped
that a little
underneath
bit.
that and right
Yeah.
back up. Yeah, so that would have been one spot, and then the second spot, I think, where I would have probably gotten stopped out would have been probably somewhere around here because I mean, this is a big trade. Like that's 80 points
Right.
up. So on a 75% portfolio size, like that would have been a huge winning trade for me. But yeah, I think that's kind of how I would have looked at it. Like I would have started to ratchet things up, maybe even sold half of it, like on a day like this,
Hmm.
um, and then kept the overweight on it, and then I would have probably gotten stopped out right here, I would think.
Yeah, sorry. Just to kind of confirm what I was thinking based on what I heard you say, on that day where it kind of pushed up higher after it was already up a few days in a row, that's a spot where you might look to ratchet up your stop and sell maybe a little bit into strength. Is that right?
Correct. Yep.
Cool. Yeah,
Especially in this situation where this was 75% position,
yeah.
I would have definitely done that.
Yeah, and I'm so glad that you shared this trade because this is trading. This is going to happen, to everybody, even the best traders. So I think this is a great example to show. So,
Yep.
uh, yeah, this is excellent.
But you
Uh,
could have bought this one back actually, when you look at it.
yeah,
This was a tight day here. Like,
those two
this,
highs are pretty close.
yeah, those two highs are close. It was a tight day. This looked like a total shakeout because it came down below the breakout and
Yep,
but closed at the high. And you could have actually, if you wanted to be aggressive, you could have bought some like at the high of this little inside day here
yep,
or the high of this, right? And then just put a small stop on that and then just let it go. And you would have probably been okay with it.
yeah. But it happens. It happens to everybody.
Yeah, it
Yeah,
happens to everyone. So yeah, you got to just learn to live with it.
yeah, excellent. One other question I had for you was in terms of your overall account, do you have kind of a circuit breaker rule regarding, percent off highs where you'll kind of say, okay, I'm in a drawdown, I'm gonna trade less aggressive, I'm gonna size less. Is that something you consider, or it's more as, just kind of gradual and based on the immediate trade feedback versus looking at your equity curve specifically?
Yeah, it's a little bit of both. Like I think for my I have certain goals I'm trying to get to, like in terms of returns and stuff. So I kind of it's based off of that and kind of where my equity curve is.
Hmm.
But if things are starting to move down, I'll just get out. I'm not going to wait around probably too long. So I try to keep it as low as I can in terms of the drawdowns on the equity side.
Yeah, excellent. This has been really great. I think there's a lot of concrete tips and strategies that you shared today. So I want to thank you again for that. Just have
The only
a
one, there was
yeah,
one
go
other
ahead.
thing I wanted to just share was I was going
Sure.
to just show some of the things that I thought were kind of instrumental in me turning around my trading
Oh yeah.
and some books and things. So I just want to share that with folks. So, I found that these like 6 books or 7 books here, I've read these things a few times each, were, I thought, really, really valuable in terms of helping me turn around my trading. And then in terms of resources, I think, Richard, you guys do a great job at Trader Lion. There's so many great traders that you guys interview and so much great information that you guys have that, great resource for a beginning trader or, someone that's been trading for a long time. You always find some great stuff in there and learn from other folks. I think, I'm part of Intervening Private Access, which has been really, really helpful for me. I'm part of Dan Zanger's chartpattern.com, which is also just a great resource and a great site as well. and then Stock Market Mentor with Dan Fitzpatrick. So those are kind of the resources that I use pretty much regularly. And then those are the books that I read to really kind of help me think through all aspects of the trading, if you want to call it a game, the trading game.
Yeah, I've heard the rule mentioned multiple times, and I've been meaning to read it. What were some of the kind of the key takeaways from that one specifically? That what would be kind of your pitch to everybody to read that book?
Yeah, I mean, I think the rule is basically if you get into something that you shouldn't be in, fix it right away. The rule is just sell it. So in trading, it's just sell it. Larry Larry was at one of Mark's seminars last year, and he said, one of my rules was, I realized I was in a bad relationship, and so I just got divorced. So just end it. Like, don't sit around and I think he said that. So so don't sit around and kind of live through the pain of something that's wrong. Just fix it. Just fix it right away and be done with it and move on, because you'll waste too many cycles thinking about that, and it'll ruin everything else that you've got going on.
Yep, that ties in
So his
nicely to
rule
your
is,
topic.
what's that?
That ties in great for risk
Yeah.
management. Yeah, it's
Yeah.
good
I
life
mean, it
advice
was
too.
kind of like an eye opener. I kind of read it, and he gives some great examples in there, just in general of, um, what were the odds of him doing this and that. And, anytime he got into something that he feels like, oh, I shouldn't have done that, he just fixed it, right? Like, so just get out of a bad trade. You can always go back in. Don't sit around and, because if you're in a bad trade, you just keep holding it, thinking it's going to come back. A, you're wasting time. B, you're losing money, and you're just kind of, your mental state is going to get affected by that, and it'll impact kind of the next trade that you take. So, fix it as fast as you can if you realize you're doing something that you shouldn't be doing.
I think that's one of the favorite things that you've said today is it's attacking you on all fronts if you're trying to hold a loss. So just keep those losses small as you can. Cut them once it tells you that you should be out. I love that.
Yeah. So yeah, great books. Can't say enough about them. If you haven't read one of them, you should probably try to find one and take a read.
Yeah, excellent. Yeah, just kind of two last questions here.
Sure.
First, if you had an exercise for people to do based on your topic of risk management that you think would help their trading, what would you assign homework, if you will, to everybody watching here today?
Yeah, one of my favorite exercises was around not using stop losses. And so what I did was I downloaded all my trades from my account, and I just put them in order of where I made the most money to the amount that I lost, percentage terms and dollar terms. And then what I did was I took all the stocks or all the losses that were more than 8%. And I just said, okay, if I would have just said 8% no matter what, I'm going to stop it. If I did that, what would the impact have been to my returns for the year?
Right.
And it was eye popping for me. Like, I would look at it and I was like, holy cow. Like, it was like huge, like double digit extra return in my portfolio. And that was an eye opener. So I would recommend, like, you go through that exercise. It is a fantastic exercise to do with your own trades, and see how many trades did you do where you lost more than 8% because you didn't use stops or whatever, and see kind of what the impact would have been to your bottom line had you just said 8% for sure. And like I said, I just went through all this. 8% is probably too much for most cases,
Right.
but if you just use that as a flat rule on your trades, um, see what it does. I mean, see what it does to your equity at the end of the year. I mean, you'll have thousands of more dollars in your account probably if you would have done that.
It's amazing the impact of capping your losers can have with trading, and it's kind of an effect that you don't realize how important it is until like you said you do the math. And I think Mark did that same thing and mentions it in his book as a turning point for him is doing that same exercise and capping his
It was
losses.
in
I think
Mark's book. I think I was reading Mark's book and I stopped reading it right there, and I
did it.
downloaded it and
Yep.
went through it, and I was like, holy cow, this is eye opening here.
Yep.
So yeah, I mean, risk management, I think, is the holy grail. It's not the funnest part. Like, it's more fun to look for stocks and things that are moving up and look at charts. But to me, I think understanding the risk management and the math, and Mark does a really good job in his books walking through that, I think,
Yeah.
in terms of how you manage that, was really kind of a huge game changer for me. Because what I was noticing is I was making money, but then I was also losing the money when the market went down because I wasn't managing my risk. So it was just kind of like I had the upside, I wouldn't say figured out, but I was doing well enough that if I would have been able to cap my downside, I would have been doing real well.
Yeah, and by the way, I really liked how in this presentation, most people when they hear risk management, either they're very vague about what that means, or they just kind of think of stop losses and cutting losses. But today you also tied in market conditions to everything, position sizing, and yeah, you tied it into position sizing, total exposure, all of that, and that's such a key layer to kind of unlock because the same risk management techniques if you just do it all the time in all market conditions, it's not going to have the same effect. And you really want to be tying in reading the market, how are stocks doing, how are setups performing, all of that into how aggressive you are with your positioning, total exposure, all of that. So yeah, I just wanted to say I think that's a really important point that everybody watching should try to incorporate into what they learned today. So yeah, anything to add on that front?
No, I mean, like I said, when I started, is that was kind of a key component that I really didn't understand. Like you said, it's usually pretty vague, and I really kind of tried to study and understand what that meant. And so that's kind of the way I look at it based on kind of all these resources. I mean, like I said, I've been
Yeah.
trading for a long time, but I got a little bit from all these books and these resources and sites that I follow to kind of come up with that sort of an approach. And it seems, it works for me. So, that's kind of what I use.
Yeah, and I think your presentation today was the opposite of vague. It was very practical, and I think a lot of people can have some great takeaways. So thank you again. And just as one last question, if there's any advice that you would give people watching today, it could be trading, it could be life if you'd like. What would you kind of say to inspire them, share some tips, whatever you'd like to leave everybody with?
Yeah, I mean, I think The Rule is a great book. Like I would read that. Like, and it just doesn't apply to stocks; it applies to life in general. I think Larry's story of how he grew up and where he came from, and the rule that he learned was just it's just really inspiring, and it's a great book. It's an easy read. It's really really an awesome book. And the second thing is just if you've been trading and you've been having difficulties or you're trying to figure it out, you're new, um, you know if you're new, I think it's great because there's so much resource out there now that you can learn from, that you don't need to go through the school of hard knocks for as many years as maybe I did when I started, because there wasn't all this information readily available, or at least I didn't know about it. So yeah, I think it's a great time to trade. Believe in yourself, put the time in, the effort in, and literally you can do just as well as anyone else can trading stocks.
Yeah, excellent. I think that's a great sentiment to leave everybody with. So thank you again for your time. I really
Yeah,
enjoyed this, and to everybody watching, hope you guys did as well. Make sure to thank Deepak in the chat. The link to download the slides as well will also be there, so make sure you take a look at those. Would definitely recommend analyzing all the examples that he shared on your own. Take a look at them and on your own screens or your own charting platforms. Go ahead and do that.